Welcome back to Rise Exchange. European stocks closed 2.3% lower today as bank stocks slide the most in a year after HSBC rescued Silicon Valley Bank of United Kingdom. On Wall Street, two-year Treasury yield posts its biggest three-day decline since the aftermath of the 2008 stock market crash. These are more part of the fallout from the collapse last Friday of Silicon Valley Bank in the United States. And there's still a lot more. Speaking to me on this developing news is Kelvin, Emmanuel, a market strategist and analyst. He's also the CEO at Dairy Hill. A warm welcome to the show this evening. Sorry, Kelvin, for you. It took some time to establish connection with you there from our Abuja studios. Let's hit the ground running. What's the latest right now on the Silicon Valley Bank crisis? Bring me up to speed.
Thank you so much, Mr. Boson. Thank you for having me. So, what has happened is that
I can hear you clearly. Please go ahead, Kelvin.
Yeah.
I can hear you clearly. Please go ahead.
So what has happened is that the Federal Deposit Insurance Corporation, after the 2009 financial crisis, they established what they call the Orderly Liquidation Authority and the Deposit Insurance Fund, the DIF, pre and post liquidation process. So what has happened is that they've come in and provided a backstop for Silicon Valley Bank, and they created a bridge where you can transfer assets and liabilities of SVB to a bridge bank called the National Bank of Santa Clara, and guaranteed that the deposits that the customers have with the bank, so you have total deposits at $173 billion and you have total assets at $206 billion. So they've guaranteed that all the uninsured deposits, because what you had was you had a bank run of $42 billion, and then you had trapped funds of $131 billion. So they've guaranteed that all deposits above $250,000 are actually going to be available to customers. So that's what has happened. You know what happened after the 2008 financial crisis is that you moved from a model where banks were allowed to fail and they were allowed to go into Chapter 7 bankruptcy, which was what you saw with Lehman Brothers, into an era where, for example, the Dodd-Frank, Senator Christopher Dodd and Representative Barney Frank created legislation that placed a VOCA rule on U.S. banks that prohibited them from proprietary trading and being agents of hedge funds in the U.S. And so what you've had happen is that part of the problems Silicon Valley Bank had was they had like an exposure of $92 billion on U.S. treasuries and mortgage-backed securities. And they also had about $74 billion on their balance sheets from debts, which are mostly comprised of venture loans to startups, tech startups and other tech-enabled businesses in Silicon Valley and around the world. So, this whole situation brings into play the 2008 banking crisis, the legislation that came after that, and the need for U.S. regulators to pay closer attention to Senate Bill 2155, and especially sections 201, 203, 204, and 207 as it regards the capital adequacy ratio of U.S. banks, the implementation and enforcement of VOCA rule, and the need for them to define clear obligor limits, because you had a situation where Silicon Valley Bank was too exposed to one sector, and that caused issues for it. Also, this situation is going to change the forward guidance of the U.S. Federal Reserve on the need to raise interest rates in America to align with the inflation to interest yield curve as a way to bring down inflation through cost-push inflationary buffers.
Kelvin,
so it's going to make them come back to...
Yes. Yeah, very quickly, just to move on the conversation, got a few more points in here for everyone to understand. But how can Contagious really is the SVB crisis? We saw the Bank of England had a very quick deal with HSBC to warehouse SVB UK into HSBC. This is one of the fallout, as it were. But beyond that, what else do we know right now? How contagious is this warming around, not just in the US, but elsewhere around the world?
So in the UK, for example, the Bank of England has provided a backstop also to ensure that customers can get access to 100% of their deposits outside of the insured deposit limit in the UK, and has basically sold SVB to HSBC at a nominal price of $1. But of course, what happens is that HSBC is going to have to inherit the liabilities of SVB UK, which amounts to about £7 billion. Around the world, I do not see so much cataclysmic effects, like unintended consequences around the world, because what we were expecting that the US government was going to do, they did. They provided a backstop. In Dodd-Frank, there is what they call the Orderly Liquidation Authority, OLA, under the FDIC, that allows the US Treasury to provide capital to guarantee that customers have access to their deposits of about $131 billion. So the most important thing is that the US government has prevented a situation where SVB went into Chapter 7 bankruptcy and prevented the contagion risk that we would have seen to especially Tier 2 banks in the US from today. So I don't think that there's going to be any further negative impact on the global banking system, because the most important thing that has to be done has been done. The only thing going forward is to ensure that they tighten up the rules to ensure that this does not repeat itself again.
Okay, so you were touching on how this will impact, this banking crisis will impact interest rate decision by the US Fed. The FOMC is taking place next week. So here we have some folks on Broad Street or on Wall Street, I beg your pardon, are already saying, look, it's not likely that the Fed will move on 50 basis points. It's going to be 25 basis points, so they're going to put a stop to it. Watch situations very carefully before the next meeting again in a couple of months down the line. What's your take?
To be honest with you, there's cost push and demand pull inflationary buffers around the world for central banks. And, this situation has come up in Nigeria. It's also very existent with the US Federal Reserve. I think they need to realize that supply chain issues, especially with the war in the Baltics and how that has affected supply chain to the US, and with the current trade crisis between the US and China, has affected demand pull inflationary buffers as a means to fight inflation in the US. So it's pertinent on the incumbent administration in the US to divert, have the US Treasury advise the US Federal Reserve to divert their strategy from increasing interest rate as a means to align that curve to actually using the demand pull inflationary factors. The US government needs to address its trade relationship with China. With the escalation in the South China Sea, with the escalation with the NATO and Russia, and the escalation over Taiwan, and the fact that just a couple of days ago, last week, the Dutch Parliament approved for regulation that will place limits on the export of chips for manufacturing of all the tech gadgets to China, and that protocol between the West, the North America, and Western Europe in alignment to fight China is going to cause serious trade issues for the US government. So they need to pivot from increasing interest rates as a way to fight inflation to actually looking at the demand pull inflationary buffers, which are the supply chain issues they have from the fallout of China and Russia as a means to fight inflation. I don't frankly think, according to what Goldman Sachs has said and JP Morgan has said, that the US Treasury, considering the fallout from this situation we have, is going to continue to raise interest rate. They might decide to put it on a hold.
Okay, so what are the takeaways for startups and venture capital firms on the SVB collapse. They seem to be at the center of this as well.
For me, I think it's important for the startups to pivot away from venture debt as a way to provide temporary financing for their funding needs. It's very important because if you look at the balance sheet of Silicon Valley Bank, you see that they have $75 billion in loans, and a major chunk of that $74 billion went to startups, went to venture debt. So you have venture equity and you have venture debt. I think it's important for startups for VCs, especially the limited partners, to adjust the metrics on which they decide to award term sheets to promising startups they want to invest in, from valuation model to actually looking at the fact that startups need to pay attention to their revenue and not vanity metrics. You know, it's important because you have a situation where a lot of startups, if you look at the value to revenue ratio, there's no alignment in the value to revenue ratio. So when you have a bank, for example, that banks startups around the world and that gives out venture debt and they are not bringing in enough revenue to match up with their valuation, and you have their non-performing loan book of the bank going up, you have a situation like you've had. So for startups, I think it's important for limited partners in VC firms to adjust the metrics on which they decide to invest in companies and on which they decide to provide continuous bridge financing through venture debt when you have a slowdown in successive rounds of funding for venture equity.
So what about...
It's also important for Nigerian startups.
Yes, I was just about the question about what's the lesson for us here at home?
Yes, so the lesson for us here at home for the startup community is to begin to look at more ways of funding locally. You can see that the exchange rate crisis we have, where there is a large gulf between the official market and the parallel market, has contributed to a slowdown in the number of funding announcements you've had in Nigeria over the last 6 months. Because you have a situation where a lot of VCs, when they want to deploy capital to Nigeria and they look at registering certificate of capital imports with NOTAP at the official exchange rate of maybe 440 or 445, and they stand the risk of losing money when they want to take monies out of Nigeria. That presents like a conundrum. So it's important for Nigerian startups to begin to look at local ways through which they can get funding from institutional investors, from the pension industry, and from other institutional players in the debt capital markets. And a good way for us to achieve that is for the central bank to provide forward guidance on interest rates, on inflation, and on exchange rates. We need to seriously, as a matter of urgency, pivot away from the fixed exchange rate mechanism that we operate, because the premise on which Nigeria operates a fixed exchange mechanism is gone. It was plus or minus 30 naira. That gulf is currently at about 309 naira. We need to change the exchange rate intermediation model from fixed to floating model, where the market determines the exchange rate through a willing buyer and willing seller model. Also, the Central Bank of Nigeria needs to pay attention to the BOFI Act that was amended in 2020, November 2020, that was signed by the president. It needs to pay attention especially to sections 13 of the BOFI Act that talks about consolidation of accounting for banks, and especially as it regards holding company structures. It needs to also pay attention to obligor limits and be very specific in codifying the obligor limits to avoid having banks focus on one sector that poses a systemic risk to other areas of their lending model.
All right, thank you so much. We appreciate this analysis. Kelvin Emmanuel, CEO at Dairy Hills, thank you so much. Have a wonderful evening.